Hi everyone, thanks so much for joining. This is our Bank of England preview because this is going to be a really interesting meeting from the Bank of England. We are fully expected now, a cut from 4.25% to 4%, so that's 125 basis point cut. But it's about what comes next that's going to be really important. So let's dive straight into those charts. As you can see here, one that I always start with is the World Equity Index chart. So this is from Tuesday around lunchtime, and sea of green pretty much. Much more muted upside for European stocks compared to what we've been used to. However, what I'm really interested in is essentially the outperformance of the FTSE 100 over the last 5 days. So sea of red everywhere else as indices are trying to claw back some of the losses from last week. But what we've got here is a little gain for the pound. And that's something worth noting because we have seen some unusual set of circumstances which is boosting the FTSE 100. Now, let's go straight to interest rates. So as I said, there's a 96% chart. This is the world interest rate expectations survey or chart and gathering of that data. So it measures essentially what market analysts in the overnight and the overnight index swap indices, what they're pricing in for rate cuts from the Bank of England. So don't worry about where it comes from. You can trust Bloomberg that it's from a good source, but it basically just gives you the percentage chance of a hike or a cut. And as you can see, percentage chance of a cut at this week's meeting is 96.6%. So pretty much fully expected now, with just over actually one rate cut priced in. But what we're looking at is what comes next. So we've got all of these expectations for rate cuts all the way down to 2026. So for the next kind of just under a year, so 10 months or so, and rates are expected to be cut to 3% by the middle of the summer next year. So we've got a succession of interest rate cuts. If we look at where we're expected to be for the rest of this year, so we've got just under 2 rate cuts expected for the rest of this year. Now, it is quite interesting because there are a real mixed bag of what people are expecting out there. Some economists, in fact, there's been reports about it today on Tuesday ahead of this Bank of England meeting, think that the Bank of England will need to cut interest rates in the UK 6 times between now and into next year. So we could see some really sharp interest rate cuts, and they're expecting rates to end the year at 2.75%. Now, why are they doing that? Some people might ask, when inflation is really elevated in the UK, because inflation is at 3.6% in the UK. Well, a lot of people would argue that though inflation is high, it is temporary, and the Bank of England say that as well themselves. So we've seen an increase in inflation, largely due to the pass on of higher taxes through that national insurance tax hike that came through last October. When obviously that's a one-off adjustment, and that will fade out of the index because it is an index and it measures year-on-year comparisons, remember that. But a lot of British corporates, they are passing on that national insurance rise, and that's having an impact on inflation. So they're passing that extra cost that they have to deal with onto the consumer, and that's leading to a step up in prices. But that will fall out of the index because we're not expecting more national insurance increases, or by and large, there are tax increases expected, but they could be more stealth taxes. So we're not thinking that there's going to be a big increase in corporate tax or other tax rates that would lead to an direct impact anyway on the inflation rate like we've seen this year. So that's really what's driving that 3.6% inflation. We obviously don't want to put too much pressure on Rachel Reeves, but you can probably blame her for that one. But if inflation is coming down, then that does give the Bank of England a lot more room to cut interest rates, and they do expect inflation to be around about at the 2% rate towards the end of this year and certainly into 2026. So the other thing to point out ahead of this meeting is the vote split. So the vote split, we've got this 96% chance of a rate cut, but the vote split is always really important. So on balance, economists expect a 7-2 split, 7 voting for a cut, 2 voting not to cut, because there are still some hawks in the Bank of England who don't believe that inflation will come down as quickly, and so they don't want to cut rates. However, there is an increasing number of people that expect it to be a three-way split. So it could be 5 people voting for a 25 basis point rate cut, 2 people voting for a 50 basis point rate cut, and 2 people voting for a no rate cut at all. So I think if we get a three-way rate cut with the 5, 2, and 2, then I think that would be considered a very dovish move, because it would suggest that 2 members of the Bank of England wanted to cut interest rates by 50 basis points because they see something really worrying in the economic data. Now, what is so worrying in the UK economic data? Firstly, there's expected to be more tax rises, so more pressures on the consumer coming in the October budget. Secondly, there's also a weak growth outlook, as we all know, and we've got tariffs as well to deal with, and we've also got this real rapid softening in the labour market. So over the last year, 170,000 jobs have been lost. So that is really what's triggering those doves at the Bank of England to be incredibly cautious about the economic outlook, which is leading to more rate cuts down the line. So let's take a look at the pound as we lead up to this meeting. So we had been riding so high, and then July was all about the US dollar, right? So this is a typical pattern for a lot of the G10 currencies, whereby they were really, really strong going into July, and then they fell off course a bit because we saw that rebound in the dollar. Now, what's really interesting is that that's taken a pause in August as we start August. So we've seen a pause in that dollar strength, and we're seeing a little bit of a pullback now in the pound. So the pound is coming back as we move into August. But 2 things worth noting: we've gone through the 50-day moving average and the 100-day moving average, but we are retesting that level at 133.48. So that suggests that there is some resistance there. So there is some demand to buy pounds, but that's less to do with what's going on with the Bank of England and much more to do with a weaker dollar. But we still have this really good support at 129.80, so just below that 130 level, which is the 200-day moving average. So from a technical perspective, kind of range bound, not really looking too weak at the moment. It looks like we've certainly come to a halt in the selling, but I think if the bank, so right now the market expects another 4 rate cuts from the Bank of England after Thursday's for the next 12 months. But if there is any indication that actually it might be 5, then we could see some weakness in the pound. But I definitely think that we're very supported, certainly from a technical basis, above that 130 level. So they'd have to be really, really weak, or something that would really cause people to dive into the dollar, I think, to make the cable rate fall below that 130 level. So that's something to watch out there. Now, I also want to show you the FTSE 100, because whilst the FTSE 100 isn't directly impacted by the Bank of England rate cuts, the reason why is that there's just 75% of earnings and revenues generated from FTSE 100 companies come from overseas and outside of the UK. So, rate cuts here doesn't necessarily impact those big companies in the UK. But we are looking very good. And at the end of last week, we made a record high. So, the FTSE is looking very, very supported at these levels. It's had one of the best bounce backs. And as I said, it certainly is outperforming markets in the US and also in the UK. We had some great news on Tuesday morning from companies. Diageo's stock price riding high, up 6%, as they said that they could mitigate some of the tariff costs on those spirits by cost cutting. And you also have BP as well. That was riding high. It's risen about 4% in the last couple of sessions. That's on the back of their results, which were better than expected. So it looks like they're putting a floor under their weak performance of recent months and quarters, and that they could potentially move higher from there. Again, reducing net debt, reduce cost cutting. For UK companies, that is being rewarded by the market. However, in the US, it's a completely different thing. Tech companies and those Magnificent 7 tech stocks, and the likes of Palantir, which isn't in the Magnificent 7, but I'm sure it will be soon, they are being rewarded for spending more on AI. So you've got this dichotomy. It's a bit like 2-tier trading going on. But in the UK and the FTSE, certainly for the FTSE 100, companies that are cost cutting, being careful with their spending, and able to boost their revenues, they're being rewarded. Whereas in the US, companies that are able to spend on AI, and that's still being rewarded. So let's just take a look at the best performing stocks of the FTSE 100 over the last month. We've got some pretty good pretty strong companies, including the miners. We've got British American Tobacco, that's quite a defensive stock, but Rolls-Royce as well, Standard Chartered, so a good mixture of banks and also those defensive stocks and the defence sector, so Rolls-Royce doing well. So pretty much a good mix there. 3 stocks, though, I'd like you to watch as we come up to these this interest rate meeting, especially if the Bank of England does sound very dovish and looks like they're on a protracted path of rate cuts going forward. Look at British Land, that's a commercial property company. That will be worth noting because they'll really benefit from lower interest rates because that will really benefit their bottom line. Next as well, the massive retailer, UK's largest retailer, that will benefit from a stronger domestic consumer. And also Persimmon, that is a house builder. You cut interest rates, that's better for capital intensive house builders and other companies with those capital intensive projects. That reduces their cost of doing business and the cost of their borrowings, but also lower rates mean lower mortgage rates down the line, and that will make it more likely that people will buy homes again after a bit of a lull and certainly a weakness in UK house prices. So that's one way to get them back up. So those 3 stocks are definitely something to watch as we lead up to this. Now, the FTSE 250, that is a slightly smaller UK index, that has, again, it's been treading water. It didn't make that record high last week like the FTSE 100, but it's still very well supported. As you can see, it's above its 50-day moving average. So that means momentum is on the upside. Now, it's this FTSE 250 that could really benefit from those rate cuts, particularly if the Bank of England signal a long protracted path of rate cuts going forward. Let's just take a look at their best performing stocks. So again, it's a real mix, a mixture of some big names here. We've got Ocado, so very good consumer stocks. We've also got Wizz Air, of course, that's going to be linked as well to consumer demand and a strong consumer. We've got some technology groups. Well, they're doing pretty well because of they're just following the US basically, but Close Brothers, I want you to watch that, up 29% in the past month, and that comes after that ruling that said that banks will have only limited compensation payments for the car financing crisis. So that's not going to be as bad as expected. Hence, we're seeing some of the smaller banking groups really shoot higher, seeing their stock prices shoot higher. But overall, we think that this is going to be a really important meeting. So do watch out for Thursday. The meeting will start at 12. We will be covering it, of course. So